What were you doing in the stock market to actually make, income passively?
I mean, really, I wasn't making any. I was just investing in the stock
Mm,
market and just kind of like playing the growth game. Like, you get a financial advisor, you get bombarded once you're in the NFL with different financial advisors. Most of them are pitching stock market or their own funds that they might create, mutual funds, and even some of the real estate funds they create. And I wasn't getting a whole lot of cash flow, so that's what essentially got me into buying my first property, but also getting into my first syndication because it was like a traditional syndication is like an 8% preferred return, 70-30 split, from the profits after that, et cetera, et cetera. And I'm like, well, I can get a 15 to 20% IRR, but get an 8% preferred return. Like I like that better than the stock market. It's like, all right, they over time it's going to make 8 to 10%, but it's not a whole lot of cash flow.
mm.
So that was just my mentality. But to be honest, kind of fast forwarding to today, and something I haven't said on many podcasts, but my perspective on when I started out in real estate, I consider myself a cash flow investor. Like I was
Mm,
investing for cash flow. I chose markets that were cash flow friendly, and that's a lot heavy in the Midwest. So I
mhm.
in Indiana, Cleveland, Ohio, and Kansas City, first three markets I started investing in. But now that I've been investing for 10 years and I get to really go back, I have a bookkeeper now, go back, look at all my numbers over the years. And what I have found is those properties cash flowed well, but not as well as I would like because down the line, issues start to come up with those properties and it eats previous year's cash flow. So that's one issue. Two, when you really calculate the appreciation growth and the tax benefits, I made more money even in my cash flow markets from appreciation and tax benefits, depreciation, cost segregation studies, et cetera, than I did in cash flow. So coming to that realization has changed my perspective a ton. And that kind of leads into why I've been heavy in like private lending and owning businesses and stuff like that interests me because it's like you get a much higher cash on cash return in business and in lending for me, the interest I can charge and all that,
Mhm.
than you do in buy and hold real estate because you got to account for it might not come day one, but you got to account for capex, turnover, vacancy, all these things. And even in cash flow markets, so you might be like, oh, I got a 10% cash on cash return. And then 4 years down the line, the roof needs to be done. It's 20 grand. And that affects the last 4 years cash flow numbers. So that's the realization that I've had. And it's made me pivot a little bit to where it's like, I'm not going to look at real estate solely as cash flow in the short term.
Mhm.
So appreciation markets are much more attractive to me today than when I started because I want it to cash flow well enough. I don't want no cash flow. People who are out there buying deals that don't cash flow, I think it's crazy. But it's like, all right, now I'm more willing to invest in Arizona and Tampa is another market I'm in, and those are more appreciation markets. They don't cash flow as great, but it's like let me focus on cash flow somewhere else and buy deals that are good deals. I'm getting below market value, and they're going to go up in value a ton because now I see that most of my wealth is actually coming from the appreciation and the taxes.
Gosh, so much right there we could unpack, bro. And I was thinking the same way. Early on, I'm like, okay, I'm gonna get these doors in the Midwest where it's, cheap to get a house. But then we forget about you got to deal with the, let's just face it, the type of tenants that might cause more problems in the like D class neighborhoods. Deal with that, like you said, the cap X. And so I totally like I think I got lucky because I evaded that and went straight for Arizona. Now invested in Phoenix. What we do is co-living. So we have, houses that cash flow very well just between two houses, $209,000 in revenue and over $100,000 in cash flow between two houses in Phoenix. Plus we got the appreciation. So I totally hear you on what you were
But I
saying.
think that what you're saying is a good point to where like you can go to these appreciation markets, but do another strategy outside of long-term
Mhm.
rentals that will help in cash flow. So it used to be Airbnb, you could still do that, but some Airbnbs are struggling now. So the
Mhm.
co-living and the pad split, and some people are turning them into senior living centers. And like, can you be creative to create more cash flow in appreciation markets? And if you can do that, now you're putting yourself in a position to where I'm in an appreciation market, but I have a strategy that's allowing me to cash flow well. I think that's a great balance.
100%. So we can riff and like we have to just meet up in person at AZ and talk. But for the people who are just starting in investing, which is a lot of our audience, they have the money, but it's like, where do I go? And actually, even before we talk about more of like the business professionals, let's actually answer a question. I have a lot of athletes ask me, like, Jesse, there's sharks in the water. There's people obviously now that they see me making money, I might have my first or second contract. How do you vet the people for the athletes to let them in their circle to know like, oh, this is a person that's not just maybe like one of these investors or stock guys that let me just, manage your funds and I'll take my percentage, not really care much versus no, this is someone that actually cares about me in my corner. How were you able to trust certain people?
I think one thing I tell to professional athletes is like, come in with the mindset, because the first people that are going to approach you are financial advisors. Come in with the mindset that you don't need a financial advisor,
Mm,
because what a lot of data shows today when you're looking at the stock market, like let's say we're talking to somebody who doesn't want to invest in real estate, at least not to start. The thing is, the data shows that you can invest in ETFs and get the same kind of return that you're going to get with a financial advisor, but you're making more money because you don't have their fees on top. So if financial advisors are approaching you and they're essentially talking for the most part, getting you into stocks and bonds, you can do that on your own. Some very basic, analyzation and looking at some of the top ETFs, the bond ETFs, the VOO, for instance, in the stock market, things like that, and just go that route, and you'll actually be better off because you don't have the fees. So that's the first thing I tell guys. If you're getting approached by somebody and they're just pitching you that, they got to be adding a lot more value than that. But guys don't understand that, and and they're approached in a way of like, oh, balancing out your portfolio and doing this and that. But if you're 23 years old and you're just trying to get in the stock market, put some money in VOO, for instance, and let it ride for the next 20 years, and you're going to be all right. Like it's going to play out well. So I think starting there to where now they got to really earn that check, because why should I hire you when I could just do that? They got to show
mm,
their value in other ways. Do they have other investment opportunities? And the second thing, when it comes to real estate, so it's getting popular for people to invest in private equity, venture capital, real estate. Like it's getting talked about more. But a lot of these financial advisors are pitching it, and all they're pitching is their own personal, like their company products. And it's like you're getting a small sample size of what the marketplace has. So having that perspective, if all they're going to be pitching you is what they have in house, then you got to realize you're not getting a good viewpoint of all the different investment types and opportunities that there are out there. And I think that's disadvantageous for athletes or people in that position. So that really changes the conversation to where it's like, man, can you start to piece together the pieces you need around you instead of trying to hire a financial advisor to do it all for you? Can you find somebody that helps you vet private equity deals? Can you find somebody, or can you start listening to books and podcasts to learn about real estate? And it takes more work, so that's why guys don't do it. But I think it's a better strategy in today's marketplace.